General Mills basically just took a hatchet to prices across 2/3 of their U.S. grocery portfolio. It is March 18th, 2026, and we are looking at the Q3 results for General Mills, ticker GIS. And Miro, they essentially chose to blow up their own operating profit just to get people to buy cereal again.
They did. And the cost was, well, it was brutal. You look at operating income, it dropped down to $524.6 million. That is a 27.9% drop quarter over quarter. Honestly, it's a stark 41% collapse year over year.
Right, and the top line felt it too. Revenue fell to $4.44 billion. That is down almost 9% sequentially. And diluted earnings came in at 56 cents a share, tumbling from 78 cents last quarter, which honestly, the stock completely hated today.
Yeah, for sure. The tape was ugly. It opened around 38.60 and just faced sustained intraday selling pressure all afternoon, closed down almost 3% near 37.50. Investors they are heavily punishing the margin compression. Operating margins shrank 320 basis points down to 11.8%.
Which stings. Oh, and quick sidebar, just to keep the legal team happy, we are just sharing personal opinions here. This is not financial advice. But getting back to that margin hit, you called it a choice earlier.
Because of price cliffs, management specifically talked about getting below these psychological retail barriers, like if a box of snacks or a bag of dog food crosses a certain price tag, shoppers just walk away. So they slashed base prices to correct gaps against the competition.
Which is a huge shift. They're finally having to absorb the inflation hit themselves instead of just passing it to us. And remember, they make a ton of pet food too, but North America pet revenue still slipped 3%.
True, though a big piece of the chaos this quarter was just incredibly erratic consumer demand. CFO Kofi Bruce noted a fourfold increase in volume volatility. 1 week in January, a winter storm hits, nobody drives to the store, and their volume drops 14%.
Then the ice melts and everyone panic buys kibble and Cheerios.
Exactly. The very next week, volume spikes 21%. It is just impossible to manage manufacturing and logistics when Mother Nature is whipping demand around like that.
That sounds like a complete nightmare for supply chains. Okay, there is a lot hiding under the surface here, including a bizarrely optimistic promise from management for next quarter. Let's get into the details.
Bizarre is the right word. Actually, wait, it makes total sense when you look under the hood. The whole Q4 promise is based on, well, it is mostly a calendar trick.
A calendar trick? Like they literally have an extra week?
Exactly. It is a 53-week operating year for them. But it goes deeper than just the calendar. You really have to look at the retail inventory numbers first to understand why Q3 looked so uniquely terrible.
Right, because earlier we said consumers were freezing, but the stores themselves were doing something entirely different.
Yes, so General Mills reported an organic net sales decline of 3%. But Nielsen, the retail scanner data that tracks what people actually buy at the register, that showed global retail sales only fell 1.5%.
Okay, hold on. So people bought more food at the checkout than General Mills actually shipped out of their warehouses?
Precisely. That 1.5% gap is a massive inventory destocking event. Big box retailers, your Walmarts, your Targets, they simply stopped ordering. They are completely refusing to hold surplus inventory in the back room right now.
Which is the classic bullwhip effect. The retailers get nervous about the consumer, they squeeze their own orders, and then General Mills takes the direct hit on the top line.
Right, the manufacturer absorbs the shock, which brings us back to that very optimistic Q4 guidance. Kofi Bruce, the CFO, he was actually refreshingly blunt on the earnings call. He said, and I'm quoting here, they expect significant sequential improvement driven by factors that are, quote, mechanical in nature.
Mechanical in nature. Oh, wow, that is... at least he's honest about it.
Oh, it was very honest. He explicitly added, we are not betting on a major step up in our underlying business.
So they're basically telling Wall Street, hey, next quarter is going to look amazing on paper, but please do not mistake it for actual consumer growth. It's just the destocking strike ending plus an extra week of sales.
Exactly. It's an accounting bounce, not a demand bounce.
That is Incredibly fascinating, and it kind of highlights how trapped these legacy brands are by the big retailers.
They absolutely are, though, to be fair, they are finding some clever micro-solutions on the ground to fight back. You brought up the pet food segment earlier.
Yes, North America Pet, which was down overall, but they're pivoting hard into that new fresh line, right?
Right, the Love Made Fresh brand. They're trying to compete with those trendy direct-to-consumer fridge dog foods, but retail conversion was apparently sluggish. So they changed the physical geometry of the product.
What do you mean geometry? Like reshaping the kibble?
No, the bag itself. They rushed a new stand-up resealable pouch to the market. Jeff Harmoning noted that this one format adjustment, literally just making a pouch that stands upright in a family fridge, drives more than half of retail sales in the fresh feeding segment. It instantly accelerated their momentum in recent weeks.
That is incredible. We spend all this time dissecting billion-dollar price elasticity models, and sometimes the sales bottleneck is literally just an annoying bag that falls over next to the milk.
Pretty much. Convenience is an incredibly powerful pricing metric. It shows they can execute at the tactical level, but they still have to offset massive macro headwinds to make the math work long term.
So true. Okay, zooming out. We have wild weather volatility, giant retailers going on strike, and a mechanical fourth quarter salvation waiting in the wings. So where does this actually leave their trajectory heading into next year?
It leaves them playing defense. Because if you cannot rely on organic demand right now, and they clearly cannot with those price cliffs, you have to find the money inside your own walls.
Right, which means cost cutting.
Exactly. I mean, they just bumped up their supply chain restructuring estimate. It went from 82 million to 96 million this quarter. They are calling it, well, the exact phrasing was, they identified additional opportunities.
Additional opportunities. That is such a sanitized corporate way to say headcount reductions or plant consolidations. But honestly, it fits the broader theme. They are clearly just cleaning house right now. I mean, look at the Brazil exit.
Right. Selling off the Café Tres Corações business.
Yeah, they are taking a massive $622 million currency translation loss just to close that chapter. That is not a minor portfolio tweak. That is an amputation.
It is, but I think it shows a necessary kind of clarity. They know the inflation-driven revenue party is over. You can see it in their long-term guidance. Jeff Harmoning specifically said, quote, in fiscal 27, we expect to deliver HMM savings of at least 4% of cost of goods sold as we accelerate the returns from our digital investments.
HMM, that's their holistic margin management program?
Exactly. So the real outlook here is not about selling more boxes of Cheerios. It's about betting the future on operational efficiency. The software and the automated supply chains have to magically claw back that margin they just gave away at the supermarket.
So just to bring it all together, they slash prices so we don't walk away from the aisle. And now they're praying that their digital supply chain investments and an accidental extra calendar week will hide the damage from Wall Street.
That's the legacy food business in a nutshell. You trade your margin for market share today, and you just hope your engineers figure out how to pay for it tomorrow.
Well put. I guess we'll be watching those savings metrics very closely next time, ideally without a blizzard messing up the scanner data.
All right. I think that is enough corporate math for one day. If you want these earnings teardowns to just magically show up for you, go ahead and follow the podcast. We do use some AI tools in the background to help us digest those massive SEC filings, but the actual curiosity is all human. Let us know what ticker we should look at next by emailing earningsunscripted@datamadness.ca or just grab the X link in the show notes. Thanks for hanging out with us.
See you next time.